Every year, thousands of small business owners overpay in taxes just because they didn't know how to pay themselves through an LLC. Businesses making 60, 80, or even 100K, choosing the right structure could mean keeping thousands in profit rather than handing it to the IRS. In this video, we will break down the debate between LLCs, S-Corps, the tax strategies, and their business structures. Let's begin. An LLC, or a limited liability company, is a legal structure that protects the owner's personal assets from business liabilities. It's a common choice for freelancers, consultants, and small business owners. From the IRS's perspective, an LLC isn't a separate tax entity. It's typically taxed as a sole proprietorship or a partnership. That means that all net profits pass through the owner's personal tax return and are hit with both income tax and the current 15.3% self-employment tax. In dollar terms, if your LLC profits $100,000, you would lose more than $15K just in self-employment tax. I don't know about you, but that sounds like Uncle Sam is pulling a fast one on us. You see, the issue is that many small businesses start with an LLC just because it's easier to set up and it provides legal protection. But what most owners don't realize is how the default tax setup can cost more than it needs to. When a business is earning 60K, 80K, or even 100K a year, that income is subject to both income tax and the 15.3% self-employment tax. That being said, understanding the concept of an S-Corp can help growing businesses reduce their tax burden and keep more of what they earn. So, what is an S-Corp? An S-Corp, or subchapter corporation, is a business that doesn't pay income tax itself. Instead, the owners report the business profits on their personal taxes. It also protects the owners from being personally responsible for business debts. It is basically a tax classification that an LLC or corporation can choose by filing IRS Form 2553. When a business elects S-Corp status, it changes how the IRS treats the business for tax purposes. The business is now responsible for paying its owner a reasonable salary, and the remaining profits can be distributed separately. The salary is still subject to the payroll taxes, Social Security, and Medicare, but the distribution is not subject to self-employment tax. Let's say a business earns 100K in net profit. Under an S-Corp structure, the owner could take 60K as a salary and 40K as a distribution. Now here's where the magic happens. Only the 60,000 will be subject to the 15.3% self-employment tax. The remaining 40K, it will now avoid it entirely, saving you thousands. Choosing between an LLC and S-Corp depends on three main factors: how much the business earns, how consistent the income is, and whether or not the owner is ready for the added responsibilities. For businesses earning under 40K in profit, sticking with a standard LLC may be more cost effective due to its simplicity. But for those earning over $40,000, the S-Corp election could offer substantial tax savings, even after accounting for added costs like payroll software, bookkeeping, and the need to file a corporate tax return. So, how can you switch structures? Switching from a standard LLC to an S-Corp involves a few steps. First, the business must already be an LLC or a corporation. Then, it needs to obtain an EIN if it doesn't already have one. Next, IRS Form 2553 must be filed, ideally by March 15th of the current tax year, to apply for that same year. After the election is approved, the business must begin running payroll and paying the owner a reasonable salary. The business must also file a corporate tax return, Form 1120-S, each year. It's also critical to maintain clean books, separate personal and business finances, and comply with any state-specific rules. In summary, LLCs are great for simplicity and liability protection, but they come with high self-employment taxes. S-Corps require more administration, but they allow business owners to avoid self-employment tax on part of their income. For consistent profits above $50,000, the tax savings from an S-Corp can be significant. If this video helped you in any way, shape or form, go ahead and smash that like button and subscribe to Finance Frog and hit that notification bell for all future videos. That's all we have for you today. We'll see you in the next one. Remember to always save smart and invest smarter.